Washington, D.C., where the International Monetary Fund and the World Bank are holding their semi-annual meetings. Let's take a look.
Counselor and the Director of the Research Department. Also with us today, Petya Koeba-Brooks. She's the Deputy Director of the Research Department. And Daniel Lee, he's Division Chief, also at the Research Department. Pierre-Olivier is going to start with some opening remarks, and then we will proceed to take your questions. I want to reiterate that we will be also taking questions from those reporters that are joining us online. And I want to remind everyone that there's a simultaneous interpretation for the press conference, that it's on the record. Without further ado, Pierre-Olivier, the floor is yours.
Well, thank you, Jose, and welcome everyone. The global economy remains on track for a gradual recovery from the pandemic and Russia's war on Ukraine. China's reopened economy is rebounding strongly. Supply chain disruptions are unwinding, while the dislocations to energy and food markets caused by the war are receding. The massive and synchronized tightening of monetary policy by most central banks is starting to bring inflation back towards its targets. At the same time, serious financial stability-related downside risks have emerged. In our latest forecast, global growth will bottom out at 2.8% this year, before rising modestly to 3% next year, almost unchanged from our January projections. Global inflation will ease, although more slowly than initially anticipated, from 8.7% last year to 7% this year and 4.9% next year. This year's slowdown is concentrated in advanced economies, where growth is expected to fall to 1.3% this year, before increasing modestly next year. By contrast, emerging market and developing economies are already pushing ahead in many cases, with year-end growth accelerating to 4.5% this year from 2.8% last year. The recent banking instability reminds us, however, that the situation remains fragile. Once again, downside risks dominate. First, inflation is much stickier than anticipated, even a few months ago. While global inflation has declined, this reflects mostly the sharp reversal in energy and food prices. But core inflation, excluding energy and food prices, has still not peaked in many countries. It is expected to decline to 6.2% this year, still well above target. Activity too shows signs of resilience. At this point in the tightening cycle, we would expect to see more signs of output and employment softening. Instead, both output and inflation estimates have been revised upwards for the last 2 quarters, suggesting stronger than expected global demand. This may call for monetary policy to tighten further or to stay tighter for longer than currently anticipated. There is little evidence of an uncontrolled wage price spiral. Nominal wage inflation continues to lag price inflation, implying a decline in real wages. But labor markets are still very tight in many countries. This suggests real wages should increase, and we expect they will. Corporate margins have surged in recent years. This is the flip side of steeply higher prices, but only modestly higher wages, and should be able to absorb much of the rising labor costs on average. As long as inflation expectations remain well anchored, as they are now, that process should not spin out of control. More worrisome are the side effects that the sharp policy tightening of the last 12 months is starting to have on the financial sector. We have repeatedly warned this would not be an easy ride. Following a prolonged period of muted inflation and low interest rates, the financial sector had become too complacent towards maturity and liquidity mismatches. Last year's rapid policy tightening triggered sizable losses on long-term fixed income assets and increased bank funding costs. The brief instability last fall in the United Kingdom's gilt market and the recent banking turbulence in the United States illustrate instead that significant vulnerabilities do exist, both among banks and non-bank financial institutions. In both cases, financial and monetary authorities took quick and strong action, and so far have prevented further instability. Broader markets have remained calm, and volatility has been contained, including for emerging and developing economies. Increasing funding costs and the need to act more prudently, however, may push banks to cut down lending further. In our World Economic Outlook, we explore such a scenario and find that it would lead to an additional 0.3% reduction in output this year. Yet, the financial system may well be tested even more. Nervous investors often look for the next weakest link, as they did with Credit Suisse, a globally systemic but ailing European bank. Financial institutions with excess leverage, credit risk, or interest rate exposure, too much dependence on short-term funding, or located in jurisdictions with limited fiscal space could become the next target. So could countries with weaker perceived fundamentals. A sharp tightening of global financial conditions, which is sometimes called a risk-off event, would have a dramatic impact on credit conditions and public finances, especially in emerging market and developing economies. It would precipitate large capital outflows, a sudden increase in risk premia, a dollar appreciation in a rush towards safety, and major declines in global activity amid lower confidence. In such a severe downside scenario, global growth this year could fall to about 1%, an outcome whose probability we estimate at about 15%. We are therefore entering a tricky phase during which economic growth remains low by historical standards, financial risks have increased, yet inflation has not decisively turned the corner. Policymakers will need a steady hand and clear communication. First, with financial instability contained, monetary policy should remain focused on bringing inflation down, but stand ready to adjust promptly as financial developments might demand. A silver lining is that the contraction in bank lending could partially mitigate the need for further monetary policy tightening. But any expectation that central banks will prematurely surrender the inflation fight would have the opposite effect, lowering yields, supporting activity beyond what is warranted, and ultimately complicating the task of central banks. Fiscal policy can also play an active role. By cooling off economic activity, a tighter fiscal policy would support monetary objectives. Appropriately designed fiscal consolidations can help rebuild much-needed fiscal buffers and help strengthen financial stability, something that we explore in Chapter 3 of our World Economic Outlook. While fiscal policy is turning less expansionary in many countries this year, more could be done to regain fiscal space. Regulators and supervisors should strengthen oversight to ensure any remaining financial fragilities don't morph into a full-blown financial crisis. For emerging market and developing economies, this also means ensuring proper access to the global financial safety net, including the IMF's precautionary arrangements, access to central bank swap lines where relevant, and foreign exchange reserves. Exchange rates should be allowed to adjust as much as possible, unless doing so raises financial stability risks or threatens price stability, in line with our integrated policy framework. Our latest projections also indicate an overall slowdown in medium-term growth forecasts. 5-year ahead growth projections declined steadily from 4.9% in 2011 to 3% this year. Some of this decline is predictable. Growth slows as countries converge. But some of the more recent slowdown may also reflect more ominous forces: the scarring impact of the pandemic, a slower pace of structural reforms, as well as the rising and increasingly real threat of geoeconomic fragmentation, leading to more trade tensions, less direct investment, and a slower pace of technology adoption and innovation across fragmented blocs. Fragmented world is unlikely to achieve progress for all or to successfully tackle global challenges such as climate change or pandemic preparedness. We must avoid that path at all costs. Thank you.
Thank you, Pierre-Olivier. And before we open the floor to your questions, just some ground rules. If you want to ask a question, raise your hand. Wait till I call on you. And if I do, please identify yourself and the media outlet you represent. And try to stick to just one question. There's a full room and we want to answer as many questions as we can. And also I want to remind that Pierre-Olivier, Petya, and Daniel are going to be able to answer questions on regions and country-specific questions related to the outlook only. Then later this week, we will have regional press briefings where other issues when it comes to regions and countries can be tackled. So with this said, I think that we're going to start here on the right with David Loder, Reuters.
Thank you, Pierre-Olivier. Hi, thank you, Pierre-Olivier. You mentioned a lot about the financial risks that we're facing, and the WEO itself goes into sort of two separate scenarios, sort of a milder downside scenario and then a really bad one that's more of a financial crisis. I'm just wondering if you can sort of tell us just how likely we are to see these events happening, given the heightened sensitivity that markets now have to stress in the banking system and the non-bank system, and then what effects you might see once we have that on emerging markets, particularly. How bad will it get for them? Thank you.
Well, so we do explore, as you point out, in our report, both we have a baseline scenario, then we have a plausible alternative scenario where we take into account the contraction in bank lending that could be coming as a consequence of the financial turbulence we had in the last month. And then we have a more extreme scenario where we try to quantify what would be the effect of a full risk-off event with a large impact, especially on emerging market and developing economies. To answer your question, when we do the assessment of the probability distribution, if you want, of the outcomes, we find that reaching something like a 1% growth rate for global output, which would be a very, very low growth rate by historical standards, something that we've only had maybe 5 times in the last 40 years or so, has a probability of about 15%. So that gives you a sense of the likelihood, if you want. But more broadly, the point I want to make here is that we've had some turbulence in the last month, and authorities have responded very strongly, very forcefully. Some lessons have clearly been learned from the global financial crisis. And also, we should point out that the banking system in particular is in much better health overall, even if there are pockets of instability, than it was 15 years ago. So all of these are good things, and they've been useful in helping to contain the risks that we are facing. But we do recognize that there is a certain amount of nervousness in the markets right now, that there are maybe some lurking vulnerabilities, and this is why it's very important at this point for financial supervisors, regulators, authorities to really go and look very carefully at those pockets of vulnerability that might still exist, whether in the banking sector, in the non-bank financial institutions, and more broadly.
Okay, let's move to this side. First row, FT.
Thank you. Chris Giles from the Financial Times. You recommend to policymakers that they should stay the course on monetary policy and fiscal policy unless things get really bad. Can you define what really bad is, and how close did we get in early March?
Well, we've had a lot of discussions around this very topic, as you can imagine, in the last few weeks, and we're still debating it internally. I think the way I would articulate it, and the way we articulate it in our World Economic Outlook, is that our assessment at this point is that the financial risks appear reasonably well contained. And given that they're reasonably well contained, it makes sense for monetary policy to stay focused on its price stability objectives. And financial instability that emerges, whether it's an individual bank or individual financial institutions, can be addressed with financial policies, liquidity facilities or interventions. For instance, in the US, we had the deposit insurance coming in. And that allows monetary policy to remain focused on the price stability objective. If we were to find ourselves, and let me be very clear, we are not in this situation. If we were to find ourselves in a situation of systemic financial crisis, maybe even beyond the adverse scenario that I described to you a minute ago, then it's very clear that objectives of financial stability would take precedence over price stability in the near term. It doesn't mean that you would abandon any nominal anchor, but it means that in the near term, you would have to put financial stability first. Where is that transition where you go from one to the other? It's a bit of a fuzzy area, as you can imagine, and it's one we're exactly trying to sort of think about more carefully. But our assessment at this point is we're not near at all that sort of transition region. So monetary policy needs to stay focused on price stability. There's a very important reason for this, which is that if at this point central banks were to pivot away from price stability, then there is a chance that the fight against inflation would not succeed. Inflation expectations would start rising, inflation would prove even more persistent, and that in itself is also a source of macroeconomic instability, and that would feed even potentially further later on into financial instability as well. So we would not be gaining on any front.
Okay, we're gonna go that first row, and then we will move to the side.
Good morning, Igor Naimushin, RIA Novosti. So the question is about Russia. IMF has raised the estimated growth for Russian economy this year and adjusted it for 2024, although it is still expected to grow 1.3%. So simultaneously, IMF sees a doubling-digit shrink in oil prices this year and still sound correction in 2024 for 5.8%. So in this case, what are the driving factors for the Russian economy to grow for these 2 years? Thank you.
Pierre-Olivier, before we answer, there's another question on Russia from TASS on WebEx, but I will formulate the question on the reporter's behalf. As the IMF increased the projection for Russia's GDP in 2023 to 0.7%, but decreased in 2024 to 1.3%, I wonder what are the reasons for such changes? Are they related to the actions of the Russian authorities?
Thank you. So let me provide some elements, and then I will turn it over to my colleague Petya here. So on Russia, we have indeed revised upwards our projection for 2023 to 0.7%. That's an upward revision by 0.4 percentage point. And we've revised downward for 2024 to 1.3%. That's a downward revision by about 0.8 percentage point. So what is our understanding of what's happening with the Russian economy here? Well, one thing we had in 2022, and we're going to get less of it in 23 and possibly into 24, there was a very strong source of revenues for the Russian economy from energy exports. Very, very high energy prices, and that helped support economic activity. In addition to that, there was a very strong fiscal impulse in Russia in 22 and continuing into 2023. But if we look forward, what we see, as you pointed out, oil prices declining. We've seen that the price of the oil sold by Russia in some cases has been substantially marked down compared to other oil indices. And we anticipate that the revenues will actually be coming down. The revenues feed into fiscal revenues as well. So that will make the fiscal situation a little bit more complicated from the point of view of the fiscal authorities. And that goes into some of our projections for 23 and 24. Petya, let me.
Thank you. Just to add a few thoughts here, it's also important to think about where growth was last year, which was at minus 2.1. So in a way, the recovery that we see this year is partly just the base effect of that. And in addition, we saw a very strong fiscal stimulus, a lot of it related to defense expenditures in the second half of last year. So the impact of that is also expected to carry over this year as well. Now, all of that being said, in the medium term, we're still projecting potential growth to be significantly lower than it was pre-war at about 0.8. And at the same time, the level of output in the medium term, we're expecting it to be lower by 7% altogether. Thanks.
We're going to move to this side. The Guardian.
Of The Guardian. You say in the WEO that you see no signs of a wage price spiral, but what we are seeing are widening corporate profit margins. So is that IMF speak for greedflation on the part of the corporate sector, which is using higher inflation as an excuse to drive through higher prices and gouge their customers?
So what we have looked at is the decomposition of the increase in prices, and you can look at it from a sort of an income source perspective. And when you do that, this is where you see that the increase in unit labor cost is only part of it, and you have a substantial part of the increase in prices, especially GDP deflator, that's coming more from the corporate side. Now, this is not ascribing motive to why that is an important component. What you have here is a situation where you had a very strong surge in demand. There's a strong aggregate demand component to the surge in inflation that we've seen, and in a context in which there was still limited supply. We had supply disruptions and things like that, especially in goods sectors first, but then services were also affected. Then you have sort of a natural response of the economic system is that prices will rise to adjust. Wages tend to take some time to adjust because they are typically adjusted less frequently than prices, and so that's why we anticipate that we're going to have some of this catch up going forward.
Okay, we're going to go right now to WebEx for a second. I think our colleagues from NHK are ready to ask a question. Please go ahead.
Morning, Mark McNamara from NHK Japan Broadcasting Corporation. Do you think you could explain why Japan's 2023 projection fell by more than all other advanced economies since the January update? That's from 1.8% to 1.3%.
Yes, I mean we had in the context of Japan, and I will then turn it over to my colleague Daniel over here. But we had a relatively disappointing last quarter of the year, and so we have a downward revision both for 2022 to 1%, and there is a carryover to 2023 in the context of relatively weak investment. So this I think is one of the drivers of the numbers, the revision in numbers that we have, but. Daniel, over to you.
Thank you. Yes, as you said, the last quarter of 2022 was more disappointing, especially on private investment. There was some uncertainty connected with the volatility of the yen, and that has a knock-on effect also on 2023, which is why there's a downward revision there. At the same time, if you look at the forecast of growth, it's going up for Japan from 1% in 2022 to 1.3% in 2023, and this reflects the supportive monetary policy in particular. The inflation rate is also starting to go up, but is very low by international standards, and that's why there is still this monetary policy support, which we support as well.
We're going to go to the left, Ed Conway, Sky News.
Thank you, Ed Conway from Sky News. 6 months ago, the UK was one of the big talking topics here in Washington after the mini-budget and what was happening in the gilts market. I just wondered, 6 months on, whether what's happened since is, cautionary tale, or have things actually, is it an exemplary case in what to do when you're faced with a crisis like that? How is the UK doing right now?
Before we reply, there's another question from Bloomberg News on the UK. Can you explain why the IMF still expects the UK to be one of the worst performing economies? Fiscal risks have receded and recent economic data has been resilient. This is from Tom Rees, Bloomberg.
Yes, thank you. So on the UK, first on the financial part, the brief instability in the gilt market, it's certainly the case that there was forceful action by the Bank of England, and that was able to calm the markets very quickly. I mean, it's one of the episodes we've had of this rapid increase in interest rates, creating some pockets of vulnerabilities in the financial sector. In that case, in vehicles that were associated with UK pensions. So certainly, as we've seen also in the US, forceful action from financial and monetary authorities was very decisive here. On the UK numbers, let me point out that first, we've had a stronger first quarter of the year in the UK, and in fact, we've had an upwards revision to our projections for 2023. It's still negative 0.3%, but it's an upward revision by about 0.3 percentage points. So we are seeing a little bit better performance for the UK economy. There is slightly less fiscal contraction action in the pipeline as we interpret it. But at the same time, there is also the effect of tighter financial conditions, which we expect to see playing out in a number of countries. Now, some of the reasons why, in terms of levels, the UK economy seems to be doing a little bit worse than some other comparable economies have not been different from our previous analysis, which is basically there is a higher dependence on imported energy with a high share of gas, and with the gas prices we've had last year, that's a major negative terms of trade shock. It's a fairly tight labor market, and so there's been a need for a fairly aggressive tightening of monetary policy, and there is some effect, already some signs of the transmission of this monetary policy to the broader economy. But let me ask maybe Petya to complement this.
I don't have anything to add.
Well, we just heard the latest briefing on the world economic outlook by the IMF chief economist Pierre-Olivier Gourinchas, the Arise business analyst Bode Oshosami. Well, he joins us now to discuss this briefing that is currently underway. Thanks for joining us, Bode. So what has changed since the last briefing that was had in January?
Well, the forecasts in January were just slightly better. So if you look at the GDP growth that is now being projected 2.8% this year and 3% in 2024, that's just slightly below the fund's estimates published in January. Obviously, that means they are seeing a trend of declining growth, albeit that decline is not very sharp. The new estimates are, like I said, just 0.1% below what we had before. And that reflects the anemic outlook, tight policy stances needed to bring down inflation, and the fallout of the recent deterioration in the banking sector, financial conditions, the ongoing war in Ukraine, and some of the geoeconomic fragmentation that seems to persist. Looking at the regional breakdown, they see the United States economy expanding by 1.6% this year, and Eurozone growing by 0.8% this year. However, they see the UK economy contracting by 0.3%. China's GDP is expected to increase by 5.2% in 2023, according to the IMF, India by 5.9%. So, yes, we have seen revisions. China was initially expected to grow 5.2% in 2023, so that's just slight improvement there. US was expected to grow 1.4%, but that was in the January. Now it's up 1.6%. So the movements have not been aggressive, but definitely we've seen that trend of improving outlook in China, also to some extent in the US. UK, of course, still not rated very well in terms of growth, and you have that 0.1% revision downwards in the global economic growth.
Well, but quoting the IMF's chief economist, he says inflation is going to be much stickier than anticipated even a few months ago. What about developing economies? How will they thrive in these tough times?
Well, indeed, it's going to be tough, because as inflation gets stickier, we know what that means. Higher interest rates are going to persist. The tightening will go on. And of course, for developing nations that are steeped in dollar-based debt, that also means more fiscal pressure. There's a lot of focus on channeling funds from countries, wealthier countries, to help the more vulnerable ones. And even when you look at the broad downplaying of if you look at the broad downward revision of economic growth, when you get global growth going down, you tend to get the impact more felt in developing economies and where they are the lower end of the value chain, which is where developing nations are. Some of the decisions that I think are going to be useful, especially to help developing nations, is to help them add more value, get them up the value chain. That typically helps, particularly when you go through challenging times like this. Of course, the other thing is for deeper collaboration, especially in governance around projects, critical projects, not just giving the money, and playing a more important role in stopping illicit capital going out of developing nations.
All right, thank you very much, Bode Osunsanmi, for that brilliant analysis.